Today's guest on Millennials Money is a spender rather than a saver. Last year, I decided to switch mainly from individual stock investing over to index fund, mutual fund, and ETF investing. And I decided to do this based on the hands-off nature of this kind of investing. And I decided it was good for me. And index fund, mutual fund, ETF investing is actually good probably for a lot of people out there. In fact, even Warren Buffett says that the majority of people should just invest in index funds or ETFs. So how do you go about doing that? And what even are mutual funds, ETFs, and index funds? Well, in this video, I'm going to give you a detailed breakdown of each of these types of funds and how to go about investing in them. So let's get into it. Welcome to Millennials with Money. My name is Johnny. Thank you for joining me for this video. Let's get this money. So let's start out by defining what is a mutual fund. Now, a mutual fund is essentially a fund of money where investors like yourself will put your money in along with lots of other people, and a manager or someone responsible for that fund will invest that money in different assets and securities with the promise, hopefully, of you getting a return from it. So essentially, investing in a mutual fund, you hand over the rights of the management of your money to an investment professional in the hope that they'll give you a return on your investment. And so when a mutual fund manager invests your money, along with all the other investors' money, into a set of assets and securities, the value of the fund will go up or down based on the performance of those assets. And that is essentially the return that you will look to reap on your investment. And at the same time, the fund will cover some commissions or some expenses, management fees essentially, related to the management cost of that mutual fund. So the ways that you'll make money through a mutual fund are through the appreciation of the assets within the fund, if any of those assets pay out a dividend, or if the fund sells any of those assets and makes a capital gain as a result. So a lot of banks, a lot of asset management companies will have their own specific mutual funds that you can invest in, and you may see them based on the type of company you're investing in. So maybe sector specific, perhaps technology, telecoms mutual funds. You might see mutual funds based on small cap or mid cap stocks. So these are all different kinds of mutual funds that you can get, and they tend to be either money market funds or sector specific funds. Now, another common type of fund that you have is an index fund. Now, these work similar to mutual funds. However, index funds typically replicate a particular index in the world global market. So a good example of an index fund is the S&P 500. You know, there are plenty of different S&P 500 funds out there available, again, from the same players like BlackRock, iShares, Vanguard. And so you can find index funds that replicate almost any index in the world, whether it be Europe, the UK, North America, Japan, developing Asia, they're all out there. So how else is an index fund different from a mutual fund? So there are other factors in play here. We can talk about the fact that a mutual fund, as we said before, there is normally a person managing that mutual fund. So it's an actively managed fund where they are regularly making operations, selling, buying, researching assets. Whereas an index fund is passively managed or managed by an algorithm, which will simply make sure that that fund regularly and constantly replicates the index that it's trying to replicate. We can also talk about the average management fees. So these fees will typically be a lot higher when it comes to mutual funds. Obviously, if you have a person managing a fund rather than a computer, then the person is going to want to get paid. They're going to want their salary and their commissions to come from that. So it's obviously going to be a lot cheaper from an expense ratio perspective to invest in an index fund than it is in a mutual fund. And in terms of investment objectives as well, as I said just before, as an index fund tries to replicate the performance of an index, it will most likely produce the performance of that index. Whereas a mutual fund is typically trying to beat the benchmarks and trying to beat the performance of an index. And then finally, we've got a third group of funds, which are known as exchange traded funds or ETFs. Now, ETFs have similar characteristics to index funds and mutual funds. However, the difference with these is that ETFs, rather than simply putting your money in and watching the performance increase over time, is that ETFs are quoted and listed on the world stock markets, and they actually quote in real time. When it comes to ETFs, you can find ETFs that resemble mutual funds in the sense that they track a specific sector or perhaps like large or small cap companies, as we just said before. You can also find ETFs that replicate the performance of an index like index funds as well. So what else is different with an ETF compared to a mutual fund or an index fund? You perhaps don't need as much capital for your initial investment when it comes to an ETF than you would do with an index fund or a mutual fund. So if you take an index fund or a mutual fund, you may need a minimum initial deposit of around €1,000, £1,000, a few $1,000s, depending on what type of fund it is, where that fund's held, who's managing it, etc., etc. When it comes to ETFs, there are platforms out there that will not ask you for the same amounts of initial capital to get started investing in ETFs. For example, let's take a platform such as DeGiro. DeGiro has a low-cost selection of ETFs that you can invest in commission-free, and you can start investing from as little as £1, €1, $1, of course, depending on your currency and where you are in the world. You can see a little bit more about DeGiro in my tutorial video that I did on it, and you can also sign up via my link in the description as well, should you decide to go ahead and invest in ETFs on the platform. There are also other platforms out there that don't have the same capital requirements as some index funds and mutual funds, some other examples being Trading 212, Bug Zero, and Vivid, which you can also check out in the links in my description. Now we've talked about the different types of funds that are out there, let me elaborate a little bit more on the benefits and advantages of these different types of funds. So as I said, last year I switched over to investing primarily in funds rather than in individual stocks because of the time saving and the hands-off approach that it requires. Obviously, I'm trying to grow this YouTube channel, and I'm also trying to enjoy my free time and do other stuff in life as well. So I don't always have the time to be sat in front of my computer, pulling reports and sitting through Excel analyses of individual stocks and companies. As fun and enjoyable as it was at times, honestly, I need to spend my time doing other things right now. That's what I ultimately decided. And so investing in funds was for me a way to continue working towards my investing goals long term and produce satisfactory returns over the long term that will keep me satisfied with minimal effort and maintenance on my side. That also allows me to enjoy my life and maximize my time productively when I'm not, looking at investing and my personal finance stuff. And because this approach is hands-off, then you know that your money is being managed by either a professional in the sector or a computer that knows how to replicate an index that you probably have the knowledge of and know what returns you can expect over the long term. So in most cases, probably 99.9% of the cases, your money is in good hands, and that gives you the peace of mind that once it's invested, you can just take your mind off it and know that your money is doing the work for you. And as we saw as we went through those different types of funds as well, the expense fees and commissions are generally pretty low when you're investing in them, so that will allow you to maximize your gains as well over the long term. But of course, you do need to keep in mind the following, because of course your money is in either the hands of a computer or a finance professional, then it's not you making the decisions, it's someone else. So you no longer have control or total control over your investment portfolio. It's being managed by someone else essentially, because within that index fund, there's a basket of assets and securities that is going to get mixed around. It's going to change from time to time. So you don't necessarily have control over that. You only have control over the funds you pick. So you have to trust the computer and the person, in the case of a mutual fund, that they have your best interests and the interests of the fund and your money in mind. And with that said, the same way that stocks can underperform, so can index funds, so can mutual funds, so can ETFs. They may not produce the desired return because, that's investing. All investing comes with a risk of loss. So it's something you do have to be prepared for as well. Even though it's hands-off and it might feel more comfortable, you still have to be aware that that investing risk is there. And then generally speaking, if you do make returns, they're not going to be astronomical returns. They're going to be good, solid returns generally. You may see some dips, some losses from time to time. Over the long term, as we've talked about on this channel, then long-term investing usually produces gains. But generally speaking, index fund, mutual fund, ETF investing is not going to produce astronomical gains, let's say. It's going to produce reasonable, fair gains, and it's going to allow you to grow your capital slowly and steadily over the long term. So how do you decide which type of fund is right for you and what funds to invest in as part of your investing strategy? Well, like anything in investing, it all depends on what your goals are, what you're looking for. For example, if you have a large amount of capital and you're just happy to let that money sit in an index fund and produce good annual returns for you, and you don't want to have to worry about, oh, how is this person managing my money, then an index fund might be right for you. However, mutual fund managers often try to beat the returns of indexes on an annual basis. So if you want to try and go for those higher returns, then maybe you want to look at a mutual fund that has a fund manager, or you want to target a specific sector in mutual funds. Or maybe you're looking for low expense ratios, but you don't necessarily have that large capital to invest with. Then why not consider an ETF where you can get those sector specific ETFs, and you can also get ETFs that replicate indices. So when you look at an ETF or an index fund or a mutual fund, how do you know what's inside it? Well, the name can give you a lot of clues to begin with. So first of all, you'll normally have the name of the asset management company. So you might see a name like iShares, BlackRock, Vanguard at the start. This will tell you which asset management company has the fund. The next part of the name will be composed of something that gives you an indication as to what kind of assets are in the fund. So if this is an index tracker, for example, it might be the name of the index. So you may see S&P 500 in there. If it's a sector specific fund, then you may see technology, you may see telecommunications, for example. And on some funds, you may see the initials UCITS. Now, this is all to do with the regulation and to ensure that the fund is compliant with standards in Europe with regards to how that fund has been managed and set up. If it's an ETF, then you'll find ETF in the name there as well. And at the end, you'll also have the currency of the fund. So whether it's euros, pounds, US dollars. And you might also find the initials DIST or ACC. Now, DIST are distributing funds, and this means that if there are assets within the fund that pay a dividend, then those dividends will be paid out to you as an investor in that fund. However, if the letters are ACC, then rather than that dividend being paid out to you, it will be reinvested back into the fund. Now, although you don't receive that money in that case, in theory, this will enhance the performance and the gains of the fund over the long term. So in either way, you come out a winner. It's just how you want to come out a winner, whether your dividends are paid out to you in person or whether they're automatically reinvested back into the fund. In the case of mutual funds, these names won't necessarily be as well detailed. You may have the asset management company at the beginning of the name, and then you may just have a little indicator as to what kind of stocks or what kind of assets are in that fund, but it doesn't tend to be as detailed as index funds and ETFs in terms of the naming convention. Now, another thing you also want to look at is the prospectus of the fund. Now, this contains key details and key information about the fund, such as what is the investment objectives and goals of the fund. It will tell you the risk profile of the fund, so if it's a very high risk fund or if it's a lower risk fund. It will tell you what the top holdings of that fund are. So this is really important to understand what assets and securities are held within that fund. So the top 10 will give you a good indication of what are the top assets that could produce major movements in that fund, should they perhaps decline or increase on the stock market in the case of stocks. But it's good to understand what assets are within that fund that you're investing in, because these are ultimately what will drive the performance of the fund. You want to look at the commissions and charges because, for example, there's a lot of S&P 500 index funds out there. However, not all of them have the same commission structure. So, for example, you might find that Vanguard has a slightly lower commission than iShares does for their S&P 500 index fund. That's just information I'm pulling off my head while I'm doing this video. Don't take my word for it, but do have a look at the charges because you may see that some funds have lower expense ratios than others. And of course, you want to have a look at the past performance of the fund as well. In the case of an index fund, I typically just compare it to the actual index to make sure that the overall trend of that index and the returns it's been producing are in line with the actual index. It's not going to be 100%, but it should be pretty close, like 99% of the way there. And understanding those returns as well. So why has a particular fund produced certain results? If it's not the case of an index fund, if it's, let's say, tech, then in 2020, of course, it would make sense that a fund a mutual fund on tech has performed incredibly well, whereas it might slow down towards the end of 21, 22. And then lastly, another thing you want to look at in the case of actively managed funds, you want to try and get a look at the fund manager. So who is the person who's managing that fund? What experience do they have? What is their track record over the long term? And would you trust them with your money, of course? So all the information that I've talked about here, you can find them on the websites of the different asset management companies, but you can also find them on sites such as Morningstar, which is a site that I frequently go to when comparing funds, ETFs and index trackers. You've also got different star ratings on Morningstar, which are risk adjusted based on the risk and the long-term track record of those funds, which can also help you in your decision making as well. So I hope you found this video helpful, guys. Are you investing in any ETFs, index funds or mutual fund? Leave a comment and let me know which ones. Now, why not check out my other videos? And if you're not yet subscribed and you want to see more content like this, then make sure you hit the subscribe button with the notification bell so that you don't miss a single update. I'll see you on the next one, and let's get this money.